All right, let's dive into a really fascinating financial puzzle, one that has kind of stumped the experts for years. We're going to unpack the brilliant research of Ebenezer Asem and Gloria Tian to explore the hidden world of momentum profits and, figure out what really makes them tick. So here's the big question to get us started. Momentum investing, buying the winners and selling the losers, it's a classic strategy. But what if its power just, poof, vanishes under certain conditions? That's the mystery we're going to try and solve today. Okay, let's officially kick off our investigation. We're going to frame this whole thing like a classic financial whodunit, the case of the vanishing profits. So check this out. This chart lays out the puzzle perfectly. The data shows that momentum strategies work great, delivering a solid 1.04% average monthly profit after the market has been going up. But then look at the right side. After the market goes down, those profits are just gone. They actually turn into a small loss. So why would a strategy that's all about trends suddenly break when the trend is heading down? This is the core problem we have to figure out. Every good mystery has its suspects, and this one's no different. So let's meet the three competing theories that have been trying to explain this weird market behavior. All right, here's our lineup. First, you've got the overconfidence model, or DHS. This is the behavioral theory, the one that says it's all in our heads, our own biases are what's driving momentum. Second is the wealth effect model, HS. Also behavioral, but its argument is that when markets go up, we all feel richer, we get a little less worried about risk, and we pile into these momentum trades. And third, the growth options model, SS, which is the rational explanation. It basically says in up markets, companies just have more opportunities to grow, which makes them riskier and, in turn, boosts momentum. So, is it psychology, risk appetite, or just rational calculation? One of these is our culprit. For years, the investigation was pretty much stalled. All three suspects had a plausible story. But then, Asem and Tian found a breakthrough clue, a totally new way to look at the data that just changed everything. And here it is, the brilliant insight. The researchers asked, what if just looking at up market versus down market is too simple? What if the real key isn't the past, but what happens next? So they broke it down. Does an up market keep going up, or does it transition down? And does a down market keep going down, or does it transition up? This simple little shift in perspective is the key that's going to unlock this whole mystery. So this new lens, it creates the perfect test. Just look at this table. For what happens after an up market, all three theories pretty much agree. High profits if things continue, low profits if they reverse. Not much help there. But, and this is the important part, look at those bottom two rows. What happens after a down market? Here, the theories make totally opposite predictions. The overconfidence model, DHS, says you'll get high profits when a down market continues down. But the other two, HS and SS, predict the exact opposite. They say profits will only be high if the market reverses and goes up. And that's it. That's the whole ballgame. The case is going to be solved by looking at what happens after the market's been falling. The predictions are crystal clear, and they can't both be right. We finally have a way to know for sure which theory actually matches reality. All right, let's get to the showdown. It's time to bring in the hard evidence and see which of our suspects has an alibi and which one gets caught red-handed. First, let's look at the results after up markets. And yeah, just as all three theories predicted, when an up market keeps its trend going, momentum profits are a really healthy 2.09% per month. The moment it reverses and transitions down, those profits are wiped out. So far, so good, but this doesn't help us pick a winner just yet. But now for the moment of truth, the down markets. This is where our three suspects told completely different stories. So what does the evidence actually say? And here it is, the big reveal. Far from being zero, momentum profit after a down market is actually the strongest of all, a massive 3.53% a month, but only when the market keeps falling. And when it reverses and goes up, it swings to a huge loss of over 2.5%. This completely solves the original puzzle. That missing profit was there the whole time, hiding in the months where the market kept dropping. It was just being canceled out by the huge losses when the market turned around, making the average look like zero. So, we have our answer. The evidence is in, the data has spoken, and we can now deliver the final verdict. The case is solved. Let's just look at the final scorecard. The DHS overconfidence model, it predicted high profits in continuations and low profits in transitions for both UP and down markets. And as you can see, it got a perfect score, 4 for 4. Now look at the other two models. Sure, they got the UP market right, but their prediction for down markets was dead wrong. They said profits would be high when the market turned around, but that's actually when there was a massive loss. The evidence points to one theory, and one theory only. Okay, so we know who did it, investor overconfidence. But to really close the case, we need to understand the motive. How exactly does this psychological quirk create these specific patterns in the market? The way it works is actually beautiful in its symmetry. Think about it. In UP markets, you buy a stock and the price keeps rising. That feels like confirming news. It tells you are a genius, it builds your overconfidence, and it pushes prices even higher. Well, the same exact thing happens in reverse during down markets. Selling feels like the right call, and falling prices confirm that you were right, which fuels that downward momentum. But a market transition, that's disconfirming news. It's a shock to the system. It shatters that confidence and causes a sharp reversal, which just kills momentum. So what's the big takeaway here? We basically need to update our mental model. The old view was that momentum is just an upmarket strategy, but the new, much sharper understanding is that momentum is really a market continuation strategy. It thrives whenever a trend, up or down, just keeps going. That missing profit after down markets was never really missing. It was just a statistical illusion created by a huge gain and a huge loss completely canceling each other out. It's a really powerful explanation. A core psychological bias seems to be driving one of the most famous effects in all of finance. But does this actually hold true for investors all around the world? And here's the final fascinating twist. When researchers ran this same analysis on international markets, the pattern didn't hold up. In some places, like Japan, it's actually the opposite. Momentum profits are big after down markets, but not up markets. This suggests that the driver isn't some universal law of finance, but might actually be a behavioral trait that's specific to U.S. investors. And that opens up a whole new mystery. What makes investor psychology so different from one country to the next?